Hey guys, it's Ryan, forging a path to financial freedom for the self-employed. It's creeping up on that time of year again, tax time. And while it's probably too late to do much about last year, it's not too late to get yourself set up the right way for next year to ensure that you're not sending more to Uncle Sam than you have to. Now don't get me wrong, I'm a taxpayer and I'm more than willing to do my part contributing to the pot what's owed. But that doesn't mean we shouldn't be taking advantage of every benefit afforded to us under the tax code to save a buck. Something as simple as choosing the right structure for your business can be all the difference between getting a bill or writing a check when it comes to taxes. So today, let's talk to John Briggs, founder of Incite Tax and Accounting, to be sure we're doing the right things. Let's go. For many self-employed people, especially those just starting out as sole props or partnerships, you're kind of on your own. For a business in its infancy, it's common for people to rely on friends, articles, or YouTube videos like this one to figure out all the right steps for getting established. But without professional help from the beginning, it's really easy to make seemingly minor mistakes that can cost you big over the long haul. It's for that reason we've brought in, courtesy of Eggs the podcast, tax expert John Briggs. John founded his company, Incite Tax and Accounting, for the express purpose of helping entrepreneurs avoid overpaying on taxes, to increase their cash flow immediately so that they can have more confidence in their choices and ultimately become financially resilient. Given the fact that it's nearly tax season, maybe we should pick his brain to be sure we're set up to save in the year ahead. But before we do, a quick reminder that I don't give financial or tax advice on this channel. The views shared here by our guest are his alone, and I would always encourage you to seek professional guidance on your own for your unique situation before running with what you hear on this channel or anywhere else for that matter. So John, thanks so much for joining me. There are a lot of people in my audience who are small business owners or are self-employed owners of service businesses. So I wondered if you could explain, in the eyes of the tax man anyway, what is the best way to structure our business to minimize the amount of money we have to pay in taxes?
And this is the lowest hanging fruit for a lot of small business owners as far as easy change, massive tax impact on either side. So you have corporations, there's a C Corp, which think of the Fortune 100 companies. For most small businesses, that is a terrible idea. Then you have the LLCs. Well, here's the great thing about LLCs is the tax code actually says LLCs don't exist to us. Those are state classifications that you set up with your state. But as far as we're concerned, we're going to force you to tax it like something that already exists in our tax code. And so that could be a sole proprietor. An LLC could be taxed like a sole proprietor. It could be taxed like a single member LLC. It could be taxed as a partnership. You could even make an election to tax it like a C corporation. But the winner for most people, and of course I have to disclose, you should always talk to someone about your specific situation. The S corporation for most small business owner is the best play for them. Now, let me clarify, because this is where it gets really confusing. LLCs are state entities. An S corporation is a tax status. You can't actually go to your state and say, I want to set up an S Corp. You either set up a corporation or an LLC. And then in either case, you then send a form off to the IRS that says, please treat me like an S corporation. Any competent accountant should be able to help you walk through that process. And it should be a very small nominal fee that they charge you. I've seen some sharks out there that charge a ridiculous amount of money to file 2 pages with the IRS. But so that being said, the reason the entity classification is important is because of self-employment income. The tax code defines self-employment income as something that you have to pay self-employment tax on, which currently is 15.3%. Since most election cycles run on some sort of tax promise, that percentage could change at any point, especially with inflation and the crazy government spending that happened over COVID. Like, who knows what's going to happen when it comes to that. But so if I'm a sole proprietor, let's say I make $100,000, just because I'm a sole proprietor, I automatically have an additional $15,000 of self-employment tax on top of my income tax rate. If I run that $100,000 through an S corporation, my net income, I don't pay the $15,000 self-employment tax. My income tax will be the same, but I can minimize a gigantic chunk of the self-employment tax portion. Now, I simplified that for a little bit. I mean, I can geek out on this stuff, but that's the general reason why choosing the right classification is super important. Same business, same expenses. Sole proprietor is going to pay a lot more in tax than the person who has that as an S Corp.
Thanks, John. I want to pile on that topic though by asking how soon is too soon to structure our business as you've described. My business became an LLC, taxed as an S Corp early on. And while that turned out to be the best call, apparently, once I became taxed as an S Corp, my situation became much more complicated. Suddenly, I needed a bookkeeper, a CPA, real live payroll, and so on. And these unexpected expenses were tough on my little one-man operation 10 or 12 years ago. So, do you have any thoughts about when is the right time to properly structure or restructure our business?
So I will also say this, if you ask one question to 10 CPAs, you'll get 15 different answers. So this is my answer based on my experience. I, of course, think very highly of my opinion. I've heard some CPAs say $100,000 is the number, which is ludicrous to me. Really what you're comparing is, what is the tax savings I get compared to the additional cost I have to take on? Because to your point, having an S Corp is more complicated than having just an LLC that's filing on your personal tax return as a sole proprietor. And so what costs am I going to incur? You have to run a payroll for yourself. It's IRS compliance rules. So there's some payroll fees, because I really, you'd want a professional to do that, since you don't, if you get caught with payroll stuff, like the penalties are ludicrous. They can charge up to 100% of your payroll tax and penalties. So you don't want to screw up on that. So better to pay a professional. It's a separate business return, so that's an additional fee. Okay, so if I look at the additional fees, I want to compare it to what the actual tax savings are. And so that number might be a little bit different for everybody, but in general, we have found $10,000 of taxable income is usually sufficient enough where they're going to save more in self-employment tax than taking on the additional costs. Now, it might be $1,000 extra, but look, if your net income is $10,000, $1,000 is 10% of your taxable income. That's a significant number. And of course, then from there, the higher your taxable income, the more it makes sense to take on the headache of paying professionals to kind of do that extra work.
Okay, so I see what you're saying. It seems like, broadly speaking anyway, that the cost of additional help to ensure compliance, our CPAs and other professionals, while costly, will actually save us money in the long run. But how does that work? Obviously, there's some financial outlay on behalf of the business owner, but do we get that money back? Are these kinds of services write-offable as well?
Exactly. All of that's a write-off. So if I had $10,000 going into it and I ended up paying $5,000 in fees over the course of the year, my taxable income is actually only $5,000 at that point. Let me just say that, because this comes up a lot. And in case we weren't going to go there, I want to make sure I share this, because too often we find that it seems like CPAs end up working for the government because they're just so afraid of telling the IRS auditor that they're wrong. We certainly aren't flamboyant with the way we approach auditors, but we know that they're usually pretty incompetent human beings when it comes to the tax code. They're not even trained on the tax rules. They're trained on IRS process and procedures. And so it's the CPA's job, in my opinion, to protect the client, who happens to be the one paying your bills, to help them save as much money as possible in taxes. So when it comes to write-offs in general, obviously what we're talking about, those are write-offs, but too often people miss other things that could be written off. So here's the general idea. The tax code uses a bunch of words that doesn't make any sense. Ordinary, necessary, helpful, appropriate. Okay, I can't really use those words to tell myself, is this a business write-off or not? So here's the way I simplify it. Is the money I'm about to spend related to my business in any form, shape, or fashion? If the answer is yes, then it's a write-off. And if it's a write-off, I need to pay that out of my business account. That solidifies and makes it a lot stronger if I do get audited. So obvious expenses, if I buy t-shirts and then sell them, obviously paying the cost for the t-shirt. Most people, that's intuitive to the business owner. But I don't know, what about the magazine subscription that gave you the image that inspired you to create the t-shirt in the first place? That's a write-off. What about traveling somewhere where I'm going to have a company meeting, or maybe I'm going to meet a potential client, or I'm going to meet an existing client, or I'm going to do some research on the area. Maybe I want to expand my business there. That's related to my business. So is it improving me as a business owner? That's the mindset I want everyone to realize, that those are appropriate, and you can take all of those as tax deductions, which then lowers your taxable income. You don't get that benefit if you're a W-2 employee. Your W-2 income is your W-2 income. But if you have 1099 income or business income through an S corporation, you need to be thinking this way.
Thanks so much, John. That was awesome. Really valuable stuff. If you're interested in hearing this interview in its full-length form, cruise over to Eggs the Podcast and listen in. We discuss this topic and a whole lot more that can help small businesses and self-employed people maximize their tax savings. I'll leave a link to the show down in the comments. Thanks so much for watching. Go ape on the like button if you haven't already, subscribe, and click the bell to be notified every time I drop a new show. If you like this content or anything else you found on this channel, please consider sharing it and spread the good word. Get $10 in free Bitcoin for buying $100 or more in crypto at Coinbase using the link below, and join me here every Tuesday and Friday for more. Be sure you're engaging in the comments to get the most out of our self-employed community. We'll see you guys next time.